Thanks so much for tuning into today's talking point. I'm your host Niraj Shah, and it'll be important to get in a fundamental perspective on all that's happening around us in the recent few days. I know a few days don't quite justify what a fundamental investor's positioning should be, but it'll be important to get in Trideep Bhattacharya CIO-Equities at Edelweiss Mutual Fund today on the show to try and understand what the recent developments and the recent movements of the market mean for the near to the medium term. um, in the current times, it'll be even more apt to say that in the long term we are all there. It's really great having you. Thanks for joining in. Hope all is well.
Good morning. Thanks for having me on your show.
So Trideep, the pleasure is entirely ours. So Trideep, the question that comes to mind is we know that while Q4 may turn out as it does, there's a chorus of calls around how from the sell side about how the 18% earnings estimates for FY24 might be a bit of a tough pill to swallow. So in light of the fact that we may see an earnings revision downwards if we do, as the base hypothesis, and therefore at circa 18,000, 18,100, the Nifty is looking a tad bit, not a tad bit, significantly more expensive than long-term averages too. What is it that is driving the markets higher? Is it a global factor around India being the safe haven in an otherwise disjointed, deglobalized world, or is it something else?
Yeah, I think great question as always to start with. But I think before I get to the very specifics of this question, it's worth understanding where we have got to in the way I see things. So one of the things that I've been saying since the beginning of this year has been that, overall in this year, 2023, we are likely to see recessionary conditions before rebound. At the time when I first talked about it, roundabout in Jan, markets were really roaring. And since then, I think there's probably been now more understanding and more data points pointing towards slowdown, recessionary conditions, and occasionally a bit of mishaps that we've seen in the global financial landscape as well. And as we head to, one of the things that I've been talking about as well is that as we head towards towards second half of this year, there'll come a time where rates would look like peaking, inflation would look like finally coming down, and at some point in future, earnings would look to, or countries would look to bottom out. Now, dire as may seem in the current circumstances, in 3-4 odd months, we will start to think about in those terms, whether rates have peaked out, inflation has peaked out, and whether recessionary conditions that we have been talking about is well synced in. I think this volatility is what I would call it, rather than a huge rally that we have seen in the market, is kind of trying to be ahead of the curve with regards to that. As you always know, market is ahead of earnings. The market has been discounting the recessionary conditions, the fall in earnings estimate by rather weak Jan, Feb, March, which you have seen, and now trying to grapple with that, are we near the circumstances where maybe not immediately, but in 3, 4, 5 months, you see earnings bottoming out or not. So that's really the market debate, if you ask me, from what the share price are trying to kind of, tell you, if you believe that way. But your data point is right. If you look through the Q4 result season, most likely on net balance, you will see earnings downgrade happen. To a certain extent, companies have already talked about it, and the markets have to digest through the extent of earnings downgrade. But particularly the consumption side of the equation would see good bit of, a tad bit lower than what expectation has been. So a long-winded answer, but it hopefully sets the context for a conversation.
Most certainly does, Trideep. So if we bake it in that markets are looking forward to earnings bottoming out, I'm trying to understand. Let's forget the next 12 months. Let's look at the 18 or 24-month scenario. What drives earnings higher relative to expectations and relative to the weightages in the index? We know that banks will probably do well. Is that already priced in? And that is part one. And part two, where can the surprise come from? Because tech doesn't look like it'll give a surprise. The other things are fairly volatile and to an extent unpredictable, because if commodities don't do well, then commodity earnings come off, even if the end user earnings would go up. So how are you kind of figuring out through this maze?
So the first thing to appreciate that in the current circumstances, at current levels of market, we are dealing with a fair value market. And effectively, the way we look at as fund managers into kind of tied through these circumstances is through stock picking. But if you look further beyond, as you are asking, 18 to 24 months, a few vistas open up. First thing to keep in mind, and somewhere towards the middle of next year, we will see elections come through. And as elections come through, if we have a stable government overall, the bottom-up story of India from a 2 to 3 year perspective continues to look fairly robust, hinged upon 3 or 4 themes. The first theme is what you touched upon, which is basically financials. Actually, there's a second one. The main independent driver, the first theme is actually the capex cycle. The chances of high chances of a capex cycle seeping through, and financials as a corollary of that, as a fund, as a sector which funds this capex overall. Hence, these two sectors as a combination would likely do fairly well over the medium-term time frame. Now, in the near term, clearly some of this is factored in, and as earnings flow by, you will see kind of the recalibration happening. But this as a theme is only going to get stronger, which is a private sector capex and lending financials being probably at the bottom of NPA recognition cycle and also corporate deleveraging cycle. So these two themes put together are, in my opinion, themes that will drive the markets, or have the potential, let's put it this way, to drive the markets higher over the next maybe 18, 24 months overall.
Okay. And therefore, the other two themes also come into question. Trideep, you want to elaborate a bit on that before I ask something else? I mean, so capex and banking is well taken. What else?
Okay. So the others are a bit country specific, which is probably why, in the wake of a little Chinese disappointment, you are seeing India being thought about as a safe haven, which is basically two things. One, indigenization of defense. This, in my opinion, is a fairly 10-year theme. Forget about 2 or 3 year theme. That will transform India's manufacturing landscape for the companies which participate in it. I think for the first time, top down, there is enough and more push towards getting things going in this area. We are actually, to tell you, short on capacity to build rather than kind of short of opportunity in this theme. And I think this is an area will flower over the next 5-10 years, so to speak. Second is basically what started off as China plus one is now becoming Europe plus one. Increasingly, what we are finding is cash-rich global companies are looking to India as a potential outsourcing opportunity, non-IT or apart from IT as well, to relocate their manufacturing facilities in India, along with some of the softs which are given by the government overall. So these 2 or 3 themes, which are very country-specific, these 2 themes make India really kind of, from a long-term destination point of view, positive. The final thing that I would point out is real estate. While in many other countries is going through really bad times, in our country is on the right side of the gradient. In other words, I mean, in my opinion, from a long-term standpoint, I would say that we are probably, in the first couple of years, in the 5 to 7 year residential cycle, where real estate is today. So again, 3 very bottom-up themes, very India-specific, and hence kind of makes India on a relative basis, if you look at last few days, maybe even a favorite destination for FIIs going forward.
Okay. In some sense, therefore, and please correct me if I'm wrong, but I'm trying to understand, are you positioning or starting to position your portfolios in a way that it would not matter to you if the Nifty stays or the benchmark indices stay flat for the next 12 to 18 months, because bottom-up ideas, non-index ideas, which are large enough to execute, fill up the portfolios and give the gains, because they might anyways do well independent of what the Nifty does.
You almost took the words out of my mouth. That okay. Yes, that and it goes with how we manage. We at Edelweiss AMC also manage funds, in the sense we are more bottom up rather than macro, so to speak. And hence those 5 themes that I talked about are very bottom up. And for example, the representation of defense in broader indices is fairly next to minimal. Even capital goods is fairly lightly represented in the broader index. And financials, of course, is big, but all other areas are relatively kind of ill represented in index today. So in terms of portfolio construction, we are generally bottom up, but these 5 themes make me orient towards specific niches where money making opportunities lie, which might be the case over the next 12 to 18 months.
Great. I want to probe a couple of these, if you don't mind. One of them is capital goods. Now, I was speaking to somebody on the sell side who was very constructive on capex, and the person was telling me that across multiple counts why cap goods makes sense. In that one, if the ABB, Siemens, Cummins of the world currently look expensive, or they are expensive, but if they are expensive, that is, their last 10-year average valuations are circa the current valuation. So in that sense, on a relative basis, they are not very expensive. And part two, if you look, if they were matching the growth in EBITDA in the previous cycle and trying to correlate as to where we are currently and what the growth numbers could look like. I don't know how you are thinking through this, but can you tell us why is it that cap goods may make sense despite very high starting valuation, say for maybe a Larsen, and I know I don't want you to talk on stocks. I'm just enumerating that so that the viewers can understand. Say for Larsen, almost everything else is not starting off at a cheap valuation. What is the possibility of making money then?
Insightful question. So, as you know, I call this the PE multiples, EBITDA multiples as static valuations. Static valuations are functions of how nicely or how rightly the earnings estimates are struck, and then, of course, the price. So, for instance, some of the companies, without getting into company specifics that you said, if I just look at a last results season, which went by, in fact, they beat consensus earnings estimates at that point in time by 30 or 40%. So, and these are kind of reasonably well-tracked names. So, I would say that when sectoral tailwinds exist, when the maybe a few things are falling in place in macro as well as bottom up, which is like data centers as an opportunity, renewables as an opportunity, all of them leading to manufacturing as an companies which are aligned to that. Then sometimes, particularly for cyclical companies like capital goods, earnings could be kind of undercooked, and that is where ultimately the money making opportunity really lies, to understand what is the right earnings that one could look at 2, 3, 4 years down the line if we do have a private sector capex cycle come through. I think beyond this, if I were to say, it will have to be company specific. So I would say from a sectoral point of view, the focus of research should be in that direction. And whichever companies have the most element of earnings surprise coming through would be the winners, and those are the ones to be betting on.
Okay. On the final question, Trideep, on the real estate thing. So because we can't talk about everything, due paucity of time, but real estate is intriguing. Because they've had a bit of a corrective move while interest rates were moving up, but there is enough smart folk out there who say that real estate is actually an economy sensitive, not an interest rate sensitive. My question to you is, how long could the upcycle in real estate be? Because proponents argue that if you take a look at China and what happened to Chinese real estate when the per capita moved from whatever, northwards of 2000 to where it is currently, and if India is mapped to do the same trajectory, then you're looking at a really long and a really large upcycle ahead. How constructive are you on real estate?
So even with us, sometimes when we look at data in China, we get too carried away. But very simplistic, a few data points, even if you just look at historical real estate cycles in India, they have been generally in the range of 5 to 7 years. That's classic real estate cycle overall. It takes that many years to sort of peak to bottom and bottom to peak. And if you look at one representative of where real estate sector today is, the cleanest variable to look at is housing unsold inventory. And if you look at housing unsold inventory, we are hovering around 12-year bottoms. So overall, hence my statement that in the context of the real estate cycle, given how historical real estate cycles in India have been, it's generally a 5 to 7 year cycle. And it seems from practical circumstances, given looking at data like unsold inventory, we are probably in the first couple of years in that cycle. How steep the gradient is likely to be, how broad-based is it likely to be, those are a matter of details, which will be a function of how fast rates go up, whether it is kind of tier 2, tier 3 centric, or tier 1, or all broad-based across cities. Those are the specs or the nuances that is subject to research. But broadly speaking, if you look at real estate, contrary to what we are seeing in many other countries, you mentioned China, even in the United States, new home sales have fallen quite badly. This is a very idiosyncratic, country-specific sector, which is on the right track after having seen multiple bad days or years, whether it was RERA or demonetization or GST. A lot of headwinds have flown by, and now the sector is relatively clean, and hence probably on a sustainable positive uptrend.
And just last 30-second answer, you're playing it both through real estate companies as well as ancillaries, or are you playing it in a specific fashion?
So, great question. So you can play this direct plays on real estate or indirect plays on real estate. In our portfolios at the moment, we'll probably be more overweight indirect plays on real estate, like building materials and areas like these, along with a few direct real estate names, but that will be probably smaller.
Got it. Trideep, fantastic getting these nuances from you. Thank you so much for taking the time out and being with us today on Talking Point.
Pleasure always discussing with you.
Thank you. And viewers, thanks for tuning into this show.
Yes.